Hannah Kesler.
This gal started her own bank at the age of 18, and then you became a self-made millionaire by the age of 24?
I did.
Hannah Kesler is a money mentor.
She's known as the single millionaire chick.
With advice on how to stop living paycheck to paycheck.
Money starts with your mindset.
How you think about your money is going to greatly impact how much money that you have.
I grew up in a town called Olathe, Kansas. I'd be walking out of the door, going to school, and my mama would holler at me, "Hannah, make good choices." And I'd have to holler back, "Because the choices I make today will affect my future."
My parents, they did a very good job about teaching me as a child how to handle my money.
We have a lack of understanding when it comes to money.
If you want your kids to have money, you need to start talking to them about it while they're young.
I'm really second generation to this concept that's called the infinite banking concept.
And at 18 years old, my dad gave me the choice to start my own bank that then led me to becoming a millionaire by the time I was 24.
Now you've written a book to help tie it all together.
So the companion is really just teaching kids that, not specifically money, but really important life lessons.
Now being the owner of the Money Multiplier, I help serve over 17,000 clients in every state of the country.
Where can people get the book?
HannahKesler.com. Hannah spelled the same way forwards and backwards, Kesler with one S.
Also, I got my podcast show, the Money Multiplier Podcast.
And make good choices today, because the choices you make today will affect your future. Good morning, Money Multipliers. I missed y'all last week. It's good to see y'all. I know I'm a few minutes tardy, okay? Yes, last week it was your girl's birthday. We're 27. We're still growing up. We're still figuring it out, but it's fun. This is what life's about. It's about the journey, right? And what we collect along the way, the memories, and, just hanging out, enjoying this lifetime. So I had a girlfriend spend the night last night, so I'm sorry I'm a little tardy on y'all today. We had fun. But let me give y'all a little update. So last week I wasn't here because I did a talk that I'm super proud of, honestly. I'm very, very proud of this talk that I gave. I will be posting it out here in a little bit. But I walked into this conversation talking about if this was the last talk that I've ever delivered in my life, what would I want to say? And the title of my talk was Lessons I've Learned as a Millionaire by 24. And what's kind of funny, and this is the conversations that we have weekly with Money Mornings with Hannah, is that money has a lot to do with your mindset and your habits, more so than how you can earn the money. We talk over here more about how you can control the money that you are already earning. Because if you really think about it, a lot of these wealthy families, we all have access to the same financial tools. It's just how are the wealthy using these tools differently than us over here, the average everyday Joes and the people. So after I figured it out, and really given all the props to Pops, I just kind of want to deliver the message of how money doesn't have to dictate your time, your location, and y'all can do whatever you want to do with your time. So speaking of, we are here this week, and then next week when I see y'all, we'll be down in the Keys. It's lobster season over here in Florida. We love lobster season. Now, given I do not dive, okay? I do not have my dive certification, but my siblings do. So what's kind of funny is that they will go down with their tanks on their back and they'll have their wetsuits on and whatever, right? So they'll go down, they'll go dive with their little ticklers and take the lobster hotel with them. And then I'll follow with my snorkel on the top end and I'll kind of watch them and I'll be following along. So that's what we're going to do next week. So we have the family vacation coming up. And hey, this is our annual family banking meeting. So something I was kind of thinking about this morning as I was getting ready, I wanted to check in with y'all because every year, the Kesler family, we get together and we have an annual family banking meeting. And it's essentially just like staying up to date with what is everybody doing? What are the goals? How are we keeping money within the banking system of the family? How are we continuing to give back to charitable organizations? And what assets do we want to buy this next coming year? So, and especially it's kind of unique right now because, you know, hey, we're all adults, you know, like I'm 27, my younger brother's 25, my older brother is 38. Sean, are you 38? If you're listening, chime in. But anyways, it's interesting because now we're all older and we got our own stuff going on. You know, Sean has his family. Zach's got his girlfriend. You know, they're doing stuff. I'm a single girl with my cats over here. You can call me the crazy cat lady. But you know, it's different because we're not dependent of mom and dad anymore. So we have more autonomy over our money and our wealth building. And so we get together as a family and we just kind of hold each other accountable and we set goals of what do we want to do as we progress forward. And by the way, it can also, for tax purposes, maybe be used as a business meeting. But I'm not a tax professional or a tax advisor, so please go talk to your people. All right, but I'm excited for today's topic, okay? So as a reminder, this is Money Mornings with Hannah. I'm here every Thursday, 9 a.m. Eastern time. I will go live, and you can catch these recordings on podcasting platforms and on YouTube underneath the streams section on the YouTube channel. And if you don't want to wait for the live streams, you can catch the podcast show, the Money Multiplier podcast, every Tuesday. That one launches. Now, let me tell y'all something, okay? Because if you guys do chime into both, what's the right word, channels or shows, I should say, here's kind of how I'm taking this. The live stream shows, this is where I get more into the advanced topics of the infinite banking concept and money, and the Money Multiplier podcast, that is more geared towards, you know, if this is new to you, you've never heard about the infinite banking concept before, you have the questions, you're kind of just doing your initial research, that's where I would start. But as always, you're welcome to join us here, Money Mornings, but I will say this is more of the advanced topic show that we'll get into more of the nitty gritties for the infinite banking vets is what I like to call y'all. So we have a few people chiming in. Hold on. Miss Fern is saying, good morning. Happy belated birthday. Thank you, my love. And happy birthday to you, Miss Leo. And Dave as well. Thank you. No, good morning. Good to see y'all. So, okay, today's episode, I want to talk about, can you stop paying premiums on your infinite banking policy? Now, let's talk about this. If you are not familiar with the infinite banking concept, I would highly encourage you to go to themoneymultiplier.com/presentation, where we get into the foundation of what is infinite banking, why are we practicing this, how are we implementing this strategy within our lives. That's where I would start. But high level, right? Instead of me keeping my wealth with the local banks, I'm storing my wealth inside of my whole life insurance policies. And the whole life policy has to be designed specifically for high immediate cash value. So what I mean by that is when I pay my premium inside of this policy, then immediately there's cash value in there that I can leverage and take out that cash value. And I can either pay off my debt, I can finance for purchases, I can start saving up and funding for tax-free income during retirement in the future. So no matter what it is, we're just financing everything through our policies instead of keeping the money at the bank. And losing out on what's called opportunity cost, the interest we could have earned on that money. I'm closing that gap now and I'm getting on the right side of compound interest because I'm doing the one step of where my money goes first. I'm flowing the money through the policy first, and then I'll take it out to go pay debt, buy the expense, pay the bill, whatever it is, right? So a little update, like over here, what I'm kind of prepping for. October's coming up here soon. I have property taxes coming due, right? So I'm kind of prepping and I'm looking in the near future, hey, what are some expenses coming up? And I'm checking my policies and the cash value in them to see which policy do I want to pull that money from to go pay Volusia County, you know? So that's what I'm personally doing right now. So I kind of just wanted to do a check-in with y'all. Hey, is there some upcoming expenses? Let's even go a few months out from now. Christmas. I'll be doing a Christmas episode. We're kind of just getting into Q4 topics of what I want to talk about on the podcast show. But every year I do an episode on how I'm funding for Christmas presents, right? I mean, some of y'all kind of go all out on Christmas. Like, how can I recoup some of that money that I'm spending on my Christmas expenses? But I want y'all to ask yourselves, how much effort are you putting towards your policies? I mean, seriously, are you treating yourself as your number one asset? Are you really taking into consideration these premiums that you're paying? On my sheets, when I'm looking at my financial life, the first thing I have underneath my expenses is pay myself first. And that pay myself first, that's my premiums that I'm putting inside of my policies. So how much effort are you really paying attention to this pay yourself first and capitalizing on your banking system? That this is your warehouse of your money. This is your system. And so you should be treating those premiums with the utmost respect, in my opinion, because your money has to be stored somewhere. Stop just leaving it down at the bank and the bankers are using your money and they're making a good living off of you. Don't do that. Treat yourself as your number one asset, because you are. Your ability to create, to provide, to give back, that is your asset. And not to get all philosophical over here, but like that I feel like that's the whole reason that we're put on this planet, is to learn, to evolve, to give back, to create. And so your ability to do that is your number one asset. So when it comes to your money life, treat yourself in that same manner. So pay yourself first, and then that's the premiums that go inside of your policy. But also too, even when you are paying your premiums, how much attention are you giving to this system? Are you looking at your policies on a quarterly basis? Are you prepping for the expenses that are coming up? I know what I'm doing over here, but this is my financial life. I'm talking about your financial life, and are you holding yourself to that same respect and accountability? Just ask yourself that question. So I wanted to ask all that today. That was something I was thinking about while I was getting ready this morning. But okay, I want to show you also some illustrations, okay? Because I have somebody who, she's been doing her policy. She's in her third year now doing her policy. And she would like to retire in about 8 years when she's age 55. And she asked me the question. She goes, well, Hannah, what if I don't want to continue to pay my premiums? Am I totally locked in? Like, what if I don't even want to pay the base premium of my contract? Because reminder, right? There's two moving parts that come together and make your full premiums that you're depositing into your policy. What's called the base premium, and then what's called the paid up addition rider. And right, that's the secret sauce, if you want to call it that's what we're adding on to the policy. And that's what allows us to have the cash value made available to us immediately, is that paid up addition. So paid up addition rider, it's not a mandatory premium, right? So that's why I always tell y'all, hey, if you ever have a downtime and you call me up and you're like, Hannah, I just cannot pay my premium right now. What are my options? You can always go in there and lower down the premium, remove that paid up edition rider, and it's that base premium. That base premium is that required dollar amount that we have to put in to keep the policy alive and active. But can I stop even paying that base premium? Yes. Yes, you can. Do I recommend it in the early years? No. And let me tell you why. So, in the early years, well, let me even back it up. Let me talk to y'all about this. This is why, okay, let me just get on my soapbox for a second. This is why an IUL contract can never be used for the infinite banking concept, and why only whole life can be used. Because you cannot pay up an index universal life contract. Any universal life contract, you cannot just simply pay it up because there's a renewal cost of insurance in that contract. But in a whole life policy, the cost of insurance is fixed. It cannot go up, it cannot go down. The cost of the insurance in a whole life contract is the base premium. So, can you stop paying the base premium? Yes, you can. And how do you do that? You change the policy to what's called a reduced paid up. Reduced paid up, you'll also hear me refer to it as RPU, reduced paid up. So that's why, again, infinite banking, you can only use a whole life contract, because IULs, you cannot truly just pay up that contract. There's always going to be a cost of the insurance that's always going to have to be getting paid. So what does this mean? Let me give you a visual. Add to stage. Okay, do you see my little screenshot here? I took a screenshot. This is not the full illustration, okay, compliance reasons, but I didn't want to totally expose this individual, okay, because this is a real life policy. This is her policy. And here you'll notice that premiums are no longer being paid after age 55. Year 9 premiums stop when she's age 56, and there's no more premiums after that. So she can come in here and she can reduce pay up this policy. So what does that mean? That means that premiums will stop. No more paid up additions, no more base premium. There's $0 of out-of-pocket cash going towards the policy now. And what that means then is her death benefit. Look at the very far right column. Her death benefit drops. Do you see how it drops from 2.1 down to 768? It's reduced paying up the policy. You're reducing the death benefit to the present value of where that death benefit is truly at. Now, the death benefit would be at 2.1 million, assuming she continued to pay her premiums. But now she's making a change to the contract, no longer paying her premiums. So the policy is now reducing the death benefit of where that true present value is of that death benefit. I know that's a mouthful, and I hope I'm making sense, but I know I'm getting into the technicality of this all, and my engineers who are listening to me, they're like, yes, Hannah, we love this stuff. We love this stuff. But for my people who don't like to really get so deep into the weeds, you can ignore all of that. All you got to understand is that, hey, the premiums can drop. The premiums can be stopped, okay, when you reduce pay up a policy. They can be stopped. And then the subsequent to that is then your death benefit does drop, though, however, okay? So that's really just what I'm saying. But let's just see kind of what happens in the cash value growth, because even though she's not paying premiums, the question y'all ask me is, well, Hannah, will I still receive interest in my policy? Will I still receive the potential dividends as well? And the answer is yes. You're still going to earn interest. You're still going to earn dividends. It just means that there's no more further out of pocket monies or capitalization that could be happening if you did continue to pay that premium. So look right here. I want you to analyze this. And let me see if y'all can follow my mouse. Can you see as I highlight? Good, good, good. Okay. Let's even blow it up slightly. This third column from the right, this is our total net cash value bucket. Okay. Starting on the left-hand side, you can see that this is just her years, okay? She's in year 3 of her policy right now, year 3. You got her age. You have her total annual outlay. This is how much money's her premium that she's putting inside the policy. And her premium that she's doing is $2,500 a month, so about $30,000 a year. So every year she's putting in that 30 grand inside of the policy is out-of-pocket money. Here's where I was mentioning by year 8, she pays her last year of premium, and then there's no more premiums after this, okay? Then you have your dividend column. That's the extra bonus, right? I can't sit here and promise y'all dividends in your contract because they're not contractually guaranteed, but with the insurance companies that I personally do business with, they've been paying dividends for over 120 plus consecutive years. So it is a strong chance that they'll continue to pay out those dividends year after year. But right, that's why we're underneath the non-guaranteed side, because dividends are not contractually guaranteed. So total net cash value, okay, this is the column that I want y'all to look at. We can talk about PUA, just quick snippet for my engineers. PUA, paid up additions, that's your paid up additions cash value and how much cash is coming from those paid up addition riders. But our total cash value bucket is this column right here. Now, here's what I want to know. Year 9, I am not paying premiums inside of this policy any longer. How much did my cash value grow? Even when I did not pay premium, how much did my cash value grow by from year 8 to year 9? Let's do the math. Year 8, my cash value is $292. Year 9, it's $303. Yes, I'm pulling out my calculator because I don't want to butch this up. 303 minus 292 is $11,000. This is an $11,000 growth, and you put $0 of money inside of this policy. Do you see what I'm talking about uninterrupted compounding and getting on the right side of compound interest? But it takes time. Okay, this is year 9 of her policy. This strategy, this is not a get rich quick kind of deal. This is something that you're implementing in your whole financial life, for your whole life. LOL, hence the name whole life insurance. Right? We are going to keep these contracts for our entire life. And the idea, okay, if you're looking at this not from the perspective of, oh, I want to have control over my money, I want it to be liquid, I want to have it in an environment where it's tax-free growth to me. If you're not even thinking about that and you're just simply looking at this thing as this is a place of where my money can grow for me, this is why it's the whole idea is get to that 3rd and 4th year, because between year 3 and 4, that's the break-even year where the cash value is growing by more than what you put into it in that year. So here, even though I'm not making premiums, because I've capitalized over these last 8 years with the compounding that's happening, that's why I'm seeing these figures of, hey, by year 8, 292, no monies go in. It grew by 303 from me not even doing anything. I mean, that's literally like a $900 cash flow every single month if you kind of even want to look at it that way. But you can see how the cash continues to grow each and every year as you literally continue to not pay those premiums. You just let this thing run on an autopilot. And notice even the death benefit, right? The death benefit will continue to grow. And the reason the death benefit continues to grow year after year, even when you are not putting any money in, is because of the dividends. Okay, like I said, I can't promise you dividends, but it's a strong likelihood they will get paid out. But those dividends go back inside of our policy as more paid up additions. So that's why it'll show up as cash value in your policy, but it also buys us a little bit of death benefit each year. So every year when my cash value continues to increase, that death benefit continues to increase too. I mean, just for shits and giggles, let's just even see like when she hits age 75, because I mean, that's the inevitable, right? I mean, time's going to pass whether you want it to or not. But even at age 75, if she does nothing but just sits on this thing, let's see how the cash grew. Here's our column right here. Age 75, it'll be this number. Let's blow it up. So 631 minus 608. That's a $23,000 growth. She put in no monies over the last, 20 or so years. No money's into it. And her cash continued to grow each and every year. That by this year, age 75, 28 years into the policy, no money's in, and it grew by $23,000. I mean, do you see kind of why I continue to buy policies every single year as I expand and I continue to grow? I mean, this is what I want. I want something that is going to grow without variables that I can't control. You know what I mean? Like, think about it this way. As I've been growing up, expanding, learning more and more and more, you know, I used to chase unrealistic returns like within my investment life. Oh, 16% over here. I can go get 16% and I hold the first position collateral. Yeah, like I want to go do that. I want to go put my money into places where that interest is continuing to grow and I want to get as much interest as I can. I want to produce cash flow every single month from these investments. And I was going out there and I was chasing these unrealistic returns. And when you have those unrealistic returns and those expectations, you kind of get yourself into financial binds that you're like, ooh, shit, I shouldn't have done this investment deal. So as I've been kind of evolving within my money life and even my money mindset, I'm more concerned about protecting the money that I have and safely growing those dollars rather than going out there and chasing returns that, fingers crossed, hopefully I'll get, right? Now, given I'm still going out there and I'm doing lending deals, I'm buying rental properties. I've been looking at some other investments, even that is involving the stock market. You know, I've been looking at some funds and some stock option trading, but I'm protecting that money first before I go and make those investments. And I'm kind of limiting the investments of those high returns that I'm getting because I'd rather protect the vault and the dollars that I currently have. You see what I'm saying? You kind of just get into this different mindset when you're like, okay, now I have the money. I don't want it to go anywhere. I want to have that control and I want to keep this money. So what's the best way and how can I do that in a safe manner? And I'm assessing all of the risk. Oh my goodness. Now my brain wants to go down this rabbit hole of, y'all, don't just look at investment opportunities and always look at the upswings of it all. Look to see what actually can negatively impact this deal. My mom is the best at this stuff. I mean, I'm telling you, she'll go through with a fine-tooth comb and iron out and look at the worst case scenarios. She does kind of a better job at that than like my father and I. we're a little too optimistic over here. But she does. Like sometimes it frustrates me because she goes into all of the what ifs, but you kind of need that voice there because life happens, shit can happen, and you think that a deal, my business owners, right? Even like partners that you bring on, you think, okay, this person is going to be amazing. This is going to be great. We're going to expand. We're going to build together. And then something happens and you're like, I wish I would have never gotten in a relationship with that person in my business. Even in your personal life with dating or relationships or marriage, you're like, oh my gosh, if I knew what I knew now, I wouldn't have done it that way. So, and I think this is just the wisdom that comes with experience in life. But specifically when it comes to my money situation, some of those investment deals that I've made, I would have never thought they would have gone south. Like I thought I was doing everything correctly, but there were just some things that I've missed. And then it's like, okay, now we got to pay for these consequences now. But it's learning, right? I mean, don't invest the dollars that you're like, okay, if I don't see this money, I'll be okay. Would it suck? Absolutely. But I'm going to be okay. So I don't know. Just make sure you do have that vault there and that protection, and you're not over leveraging yourself. Okay. Go back to our past episode where I talked about stop over leveraging yourself when it comes to your whole life contracts. Hey, Mike is chiming in. He's saying, come track your loans with lendtrack.app. I need beta testers before it goes live later this year. All right. So Mike, I'm assuming this is something that you put together. I've never used it. Okay. So of this app, but yeah, no, good stuff, man. So yeah, no, I really didn't have too much I wanted to talk about. I guess I just really wanted to like bring to the forefront of your mind that, hey, if you need to stop paying premiums, it's okay. You can always reduce pay up the contract. You can always lower the premiums. Hold on. Let me take you through my mental pathway, okay? If you are in this position or you're just curious about this, you're like, Hannah, times are tough right now. I get it. Okay. The economy, it's kind of crazy. Every time I go to Publix, I'm spending like $250 and I'm like a single girl over here. And I'm like, how in the hell am I spending that much money on my groceries? but you're maybe thinking to yourself, Hannah, I just don't know. Cash flow is kind of tight right now. I know the importance of this policy and I know the importance of paying myself first, but I kind of need a little bit of some break. Here's the step-by-step what I take myself through if I ever need to lower premium on my policy. First thing I look at, can I just minimize my premium? Can I just reduce the paid up additions for right now? That's the first thing I look at. If the answer is yes, that's what I'm going to do. Continue to capitalize on the base premium, but if I need to right now, lower down the paid up additions for the time being. And my advice there is pay the minimum, which is $10 a month, to the paid up additions to keep it attached onto the policy. Because if you don't pay your paid up additions, it's going to fall off the policy and it's hard, or sometimes you can't add it back on. So that's a funky little quirk to it though. So just reduce the paid up additions for right now. And hey, if you're a Money Multiplier member, this is where your implementation agent is there. They're there to help you and guide you as you walk through this, okay? So if you don't know who your implementation agent is, it may be Larry, it may be Jerome, it may be Wesley, maybe even Ethan, okay? But reach out to them if you come into that financial bind and they'll walk you through it. But that would be number one, lower the paid up additions. That would be my first recommendation. If you can't even do that and you can't pay your base premium, my second option would be, is there cash value in your policy that can help pay for premium? And hopefully the answer is yes. You didn't totally over leverage yourself, but that would be my second option. If there's no cash value, you totally over leverage yourself, then option number three, then hey, maybe let's look at reduce paying up the contract. Okay, stop totally paying those premiums. There's also a fourth option. You could always even sell your policy. But we can talk about that offline, okay? I don't like to totally promote that, but that's always an option. People are buying policies. Why do you think the banks have so many life insurance policies? Whole life policies, by the way. All right, last thing I want to go over with y'all. Here's the thing though. Going back to option number 3, if I do ever have to reduce pay up my contract, we do need to make sure that you're not going to hit your MEC limits, okay? MEC, M-E-C, the modified endowment contract. Because we're really getting into advanced stuff here, hold on. This is a very advanced episode, so hey, welcome. But MEC limits, right? Modified endowment contract. That's what MEC stands for. You do not want your contract to become a MEC. Is it the end of the world if your policy becomes a MEC? No, but avoid it at all costs. You're trying to minimize your tax bill and your tax liability, right? So if you try to go into a policy too early on and reduce pay it up, you could hit those MEC limits. Meaning that you too soon overfunded the contract and now you MEC'd it. You totally overstuffed it in the early years. And if you reduce pay it up too soon, then you'll hit the MEC status. In this illustration, she does not hit the MEC status. Okay, year 9, she does not hit it. When running the reduced paid up illustration, it will tell you if the policy will become a MEC or not. So the sweet spot to reduce pay up a policy is anywhere between year 7 to year 10. That's when I noticed that you're not going to run into those MEC issues. But if she went in here like year 3 and she kept continuing to max over fund into her paid up additions from year 1 to year 3, she's going to MEC her policy. And so she could reduce pay up her contract, but then it's going to be a MEC'd contract, and then now she will have those tax consequences on it. So we try to avoid that at all costs. So that's why I'm just saying, hey, at minimum, what I would say is just make sure that you can pay your base premium for 7 years at minimum. Okay, because like I mentioned, that year 7 to year 10 is kind of that sweet spot to reduce pay up the contract, and then you're fine. You're not going to hit those MEC limits whatsoever. All right. Hopefully this was helpful and not too technical, but I wanted to bring this for my technical people because I know you guys hang around and, we do the webinars. I didn't host a mastermind this year, a live mastermind event. I'll be back probably next year doing some mastermind stuff, Chris Noggle and I, but I know as you kind of advance in your journey, don't hit the arrival syndrome. Continue to learn about this stuff. Continue to go back to this black book, Becoming Your Own Banker. Send me an email. I'll even send you copies of our books. I have my children's book, The Companion. Dad also has his book, Mapping Out the Millionaire Mystery. So if you send me an email, I'll send you a copy of this, hannah@themoneymultiplier.com. Let me put it up for you. There you go. But please, y'all, I have a laundry list of, ongoing ideas that I can come here every Thursday and talk about. But I want to know from you, what is the content that you want me to go through? What specific scenarios are you doing in your life? Do you have a policy? Are you actively implementing this? If not, what's the reason why? What's holding you up? Let's have a conversation together or ask me those hard questions. And if you are doing this, what are you currently doing right now? And can I come to the table and give you tools and share with the community of why you're doing it this way? Because as you continue to expand and grow, you're going to add on more policies. Have that conversation with yourself. Are you at the point where you're ready to start an additional policy and expand the banking system? I'll tell you this, mom and pops right now, they're starting more policies. Why would they have over 30 policies in their portfolio? I don't know, maybe so I can get that $23,000 growth at year 29 in this contract and not put any money into it. Just my 2 cents, my feedback. All right. Well, it was a pleasure, y'all. I will be back next week, okay? I'll probably be in my swimsuit. Hee hee. My swimsuit, my swim shirt. We're going to go dive in. I'm going to get suntan. It'll be fun. So I'm here. Reach out to me, send me an email if you got questions for me. If you want me to go over your specific analysis and your policy contracts, I'm here. And as Mama TK always says, you got to go out, go make good choices today, because the choices you make today will affect your future. All right. Love y'all. See you next week.